Thank you again for taking the time, investing your time in watching these videos. This is part 4 of real estate investment, and we want to talk today about revenue-producing investments. We talked last week about the need to grow your net worth. We talked about various ways you can do that. We talked about savings. We saw that it's important, but it can never be enough. And then we talked about investing in appreciating assets. They won't generate revenue, they'll go up in value, they'll increase your net worth, but to get at the money that you want to enjoy in retirement, you have to sell the asset. And then we left you by talking about investing in revenue-producing assets. Now we can think about putting money in the bank, in a GIC, we can think about buying a mutual fund. Some of these things not only go up in value, but they generate you a dividend or they generate you ongoing interest, and you can take that interest and instead of putting it back into your savings, you can put it in your pocket and that can give you some revenue. The problem is it doesn't give you enough revenue. In actual fact, with the Bank of Canada rate set at 1/4%, the amount of money you get in the bank on a savings account is very, very minimal. You are lucky to just keep abreast of inflation. So we looked at various things that you could invest in that would give you a greater return, and we left you with the thought that it wouldn't be great if you could invest in something that would generate you a revenue and go up in value. And that's what real estate is all about. Real estate accomplishes both those things. Over time, real estate goes up in value. In fact, we find that most people see their net worth grow. The largest component is their home. It goes up in value over time. And in fact, it goes up greater than the rate of inflation. And the reason for that is scarcity. They're not making more land. So obviously, if you're buying out in the middle of nowhere, miles and miles from any town, maybe it's not in demand, maybe it's not going up in value. But if you're in the core of downtown Toronto, for example, it's becoming more and more expensive, as is the GTA, as is downtown St. Catharines, Niagara Falls, Welland, and so on. There is a scarcity built in with it, and so we find that property values, while they may not go up uniformly every year, they're going up quicker than the cost of inflation. All right, but then we want to look at the fact that real estate also has a revenue-producing component, and that's because real estate has utility. Let me explain what I'm talking about for a second. If you have a bar of gold, a bag full of diamonds, art on the wall, it doesn't have utility. You can't drive to work in a bar of gold. You can't eat diamonds. You can look at them, you can invest your money in them, they go up in value, but they don't have a utility. Utility can be converted to cash. People will pay you to use something that they can make use of themselves. And there's industry built around that. People rent tuxedos, people rent cars, people rent tools, and they will pay for the utility they're getting, and then they return the tuxedo, they return the car, they return the tools after, and the company that owns them can rent them out again. So people are paying for that utility. So is true with real estate. Real estate, you can live in it. And so people will pay you for the right to live in it, but you still own the asset. The other magic thing is all these other things, the tuxedos, the cars, the tools, they wear out. They become less valuable over time. But real estate, while it is generating you revenue from the utility, it's also going up in value. It's appreciating. Now, your own principal residence, we talked about that. It's a little harder to see it with your principal residence because you're not getting rent. But in a way you are, because if you didn't own the property, you would be renting and you would be paying rent. And so that equivalent cash flow going out is in your pocket in the way of savings. But to really understand it, you got to imagine that you own a rental property. Once it's free and clear, once it's paid for, then you've got the expenses to look after. They might be utilities, depending on the composition of the property, and taxes for sure, and a certain amount of maintenance and so on. But once these expenses are out of the way, the rent that you receive is yours to do with as you wish. It's like the goose that lays the golden egg. You still own the house and you enjoy the revenue. Now you're going to say, well, wait a minute, Wayne, don't you have a mortgage? Yeah, that brings me another very, very good point. See, if I'm buying art or diamonds or gold, I got to lay out all my cash. If I'm buying a house, I can put what we call a mortgage on it, and I can put a minimal amount of my cash in, and I borrow money from the bank to pay the rest of the house. And so my return on investment is much greater because my investment is much smaller. And the tenants who pay me rent, the rent I use to service the debt, and it's the tenant who pays the mortgage until that house is paid free and clear. Once it's paid free and clear, I've got the money to enjoy in my retirement. So it's the magic of having that money come in from the rent with the property that I own that's mortgaged that really enhances my investment. It's a principle we call leverage. It's making money with the use of somebody else's money, investing in a revenue-producing, appreciating asset, and borrowing money to make the acquisition, paying it off, and then enjoying a comfortable income stream on retirement. We're going to be showing you exactly how it works and how to do it. Hang on, we're going somewhere. Look forward to talking to you again next week.